All right. Welcome back to another episode of Not Financial Advice. Recently, I deployed $844 in the stock market. It is Saturday afternoon, so these funds were deployed on Friday morning and Friday evening. We're going to go over what stocks and funds I decided to buy this week. So to start off, I did make an additional investment within Smith & Wesson. My strategy this time around was to buy companies that I already own that I feel are undervalued, high quality companies. So there are some mainstream companies here. There are some sort of contrarian plays here as well. But Smith & Wesson is a small cap value stock with a great dividend, historically low debt. They're one that tends to be very secular based around elections. And so I'm averaging down my cost basis here. It's one of my larger positions, but I did add to that yesterday. So additionally, you guys, I bought Tyson. So I'm here in the Midwestern United States. And so, the breadbasket of America and the world, we produce a lot of protein here. Um, I have sort of a strange relationship with the stock because I would prefer food that's a little bit more healthy, especially protein. I would prefer organic protein, not necessarily a huge fan of processed foods. Um, At the same time, Tyson's is one of the largest producers of beef, pork, and poultry in the world. And not to be controversial, you could disagree with this if you want, but humans need to eat meat and protein. The population is growing. We're potentially in a higher for longer interest rate environment. Part of uh, part of that is combating inflation that's a little bit sticky. And so, I'm a little bit of a bear. I'm always fully invested in the market, but population is growing. The world's population likes to eat meat. This is a company that, not only makes foods that you'd see in the frozen section of a supermarket, but it's also serving institutional cafeterias, as well as a lot of its revenue, I do believe, is exported products to outside of the United States. So, I think protein is a necessity. This is a wide moat company that I think is undervalued, a dividend payer, um, a large cap value stock. I think that, meat is really a necessity. And so in this type of environment, this is an undervalued stock that I own, but I'm growing my position in. So also I went ahead and bought Alphabet. So the concept here is that um, Alphabet Google has really high margins. So they own currently search online. They also have some cloud computing type stuff going on. They got some other weird stuff that they do. But also, as far as YouTube, where you're viewing this video at, it has more watch hours than any other streaming service, Netflix or whatever. And so this company is one that has a really solid balance sheet. It's a high growth company. It's a large cap growth company with a solid balance sheet with high margins. And basically, this is just a platform where the world is entertained and buys things. It's a wide moat company. So it's one of my larger positions, and I'm adding to it because it just makes sense. So next is Berkshire Hathaway. This is a what if I'm wrong stock, so a conglomerate. Thinking about this environment that we're in, it's probably fairly or richly valued, to be fair. Um, but this is a company that um, has a lot of exposure to Apple at a low cost basis on its balance sheet. This is a publicly traded company with more cash than any other company. Um, they buy 30 and 60-day treasury notes or bonds or bills, $50 billion at a time. They have more cash than any other publicly traded company. They own companies like Heinz or Hanes Underwear, rather, Dairy Queen, Geico, um, railroads, a diversified conglomerate, one that is really smart with its ownership of financials of different bank stocks, which can benefit in a high interest rate, high inflation environment. So this is one. It's almost like buying a company that is in itself an ETF, and it's a what if I'm wrong stock. So adding there to Berkshire Hathaway. Also Meta. Um, I feel like Meta is kind of like Tyson, except I hate it even more. It's an addictive platform. It's bad, but they have Facebook, they have Instagram, which are addictive to different groups of people. Advertising takes place there. One thing that can't be understated is Meta's ownership of Marketplace, which is basically knocked off Craigslist. So there's a lot of people utilizing Meta and Facebook for a variety of different reasons. And then, that's within all different age groups here domestically, but then internationally, their platforms are popular, but they also have WhatsApp, which is a popular app or platform communication source within emerging and other developed international markets. So I think it's slightly undervalued. It's one of my stocks that I think I'm currently up over 125%. Should have bought a lot more when I did. So I am averaging up, but I think it's still undervalued, and I think it's going to be here in 10 years, so I'm buying more. Williams Sonoma, one of my big positions. Um, Previously done a video on it. This is French cast iron skillets for upscale, ritzy, older ladies. They target a high income demographic. They also own a brand called Pottery Barn. They're pretty dominant as far as a luxury sort of home goods and specifically um, kitchen wares retailer. They're one of the largest specialty online retailers, a mid cap value. Um, dividend growth. Yeah, and a stock that I think that's undervalued. So it's a mid cap value business, and it's one that I'm adding to. So here's a little bit of a contrarian turnaround play. Foot Locker has had two massive sell-offs recently. I think it's down probably 50-60% from all-time highs. It's down in the last 5 years. They have a lot of mall locations which they're moving away from. They have a CEO named Mary Dillon that was the CEO of Ulta Beauty, which has been a great performing consumer stock. But the concept is that they do have some exposure online. They've had some problems with their relationships with Nike, but they're growing in other brands. But I think that people will buy. It's sort of the same thesis I have on a different company I own, which is a bigger position of mine, which is Best Buy. I think the market thinks that physical retail is going to go away completely, and I just think certain physical retail stores won't end up like Sears. So I do think that people, when the economy is a little bit better, will still want to go to the mall, and they'll still want to go buy um, trendy sneakers. They'll want to try them on. They'll want to browse. And I think that Foot Locker has some decent brand value. They've cut their dividend, which smarter people than me say is a horrible sign. I was able to add recently. I mean, it ended up being at a 9% dividend. They'll probably reinstate it in the future, but it was way too high. And so that was a bad sign, but it's also a sign that the company, I don't think, is going to disappear. They're making the tough choices. They have good leadership. I think they have decent brand value. And I think that people are going to buy shoes in stores for the next 10 years. So it's a turnaround play. I think it's deeply significantly undervalued. Is it a value trap? We're going to find out. But that's also why I buy things like Berkshire Hathaway and Google. What if I'm wrong? And then Best Buy. So I think that people's moms are going to want to go check out washer and dryer machines before they buy them in person. It's a consumer discretionary stock. We're sort of on eggshells as to how the economy is going right now. But one thing with interest rates is that things like homes and autos and other items that have to be financed are really suffering right now. But things that can be paid for with cash or with credit, like flat screen TVs or washing machines or fridges, um, electronics, these 400, 500, $1,200 purchases, these are still purchases that the consumer wants to make. And I still think that people like to put their hands on certain products, and this should lead my company to profit. It's one that has good leadership. It's a mid-cap value stock with some really decent growth and a solid balance sheet. So I think this is a sleeper. I think this is a sleeper stock, and I'm happy to buy more of it. So we talked about Mary Dillon earlier, Ulta Beauty. I like the beauty space. I know that there's a lot of retail in here, and there's a lot of negative sentiment around retail. But my competitive advantage is that I'm an American, and by default, that means I'm a consumer, and so I can wrap my mind around consumer businesses. And this is one that is more of a defensive consumer business. This is a consumer staple. It's a retailer of beauty products, predominantly for women. Women of all ages enjoy this brand. It's a very strong brand. It's growing in popularity. They have online. Um, I believe this is a little bit more of a large cap core company. They have some really strong growth, great balance sheet, great profitability metrics, but this is just a very, very, very strong brand. And I like that exposure to things that I can understand, but also beauty is considered defense. Air raid sirens were going off in World War II. Women were still finding a way to look and feel beautiful. And so this is why I like to own businesses such as this. Nextly, if that's a word, we had my bi-monthly contribution to the total United States stock market index fund, about $294 of that in my employer Roth 401k. And then lastly, just in case, what if I'm wrong, about $100 of Charles Schwab SCHD. Everyone knows what that is. So without further ado, that's the end of the video. I won't even ask you to like and subscribe to the video since I forgot throughout the production of this whole thing. But I hope that you enjoyed this, and I'll see you on the next one.